welcome to our latest explainer. Today, we're jumping into a real head-scratcher from the world of fintech. We're talking about Affirm, one of the biggest names in buy now, pay later, and a very strange situation that unfolded after their latest earnings report. All right, so get this. This is the mystery we're going to solve today. Affirm posts this amazing, record-breaking quarter where they're actually profitable. You'd think Wall Street would love that, right? Well, the stock immediately tanked 9%. So what on earth is going on? Let's dig in.
Okay, to really understand this puzzle, you have to look at the numbers first. Because on the surface, the results Affirm just put up were frankly spectacular.
I mean, just look at this. Affirm didn't just squeak by Wall Street's expectations for the big holiday quarter, they blew them out of the water. We're talking about total revenue, the amount of stuff people bought using Affirm, and especially earnings, all came in way higher than any of the analysts predicted. But this number right here, this is the real headline. $130 million in actual, by-the-book, net income. Now, for a fast-growing tech company that was basically known for burning through cash to get bigger, this was a massive moment. It was the first time they really proved, hey, our business model can be seriously profitable. So before we get to why the market had such a strange reaction, let's do a quick refresh on Affirm's business model. How does this whole buy now, pay later engine actually run? At its very core, Affirm is a giant in the BNPL space. Think of it as a modern digital alternative to a credit card. It lets you buy something today and split the payment into installments, usually with really clear terms and sometimes with no interest at all. And this breaks down the process perfectly. You see something you want, you choose Affirm, and they step in and pay the store for you right away. Then you just pay Affirm back over time. Simple, right? And they make their money in two main ways. They charge the store a small fee for sending them a customer, and for some loans, they charge the consumer interest. Now this is a really crucial piece of the puzzle. Affirm is becoming so much more than just a button you click on a website. They have a physical and digital card now, and its use has just exploded, growing a staggering 159% in 1 year. This little card is quickly becoming the main growth engine, turning Affirm from an occasional financing tool into something people can use for everyday spending. Okay, so with all that in mind, let's look at the bull case. Why are some investors so incredibly optimistic about Affirm's future? When they look at these trends, they see a financial powerhouse just getting started. The growth story is just really compelling. It's not just that revenue's up 30% or that more people are signing up. The key here is that customers who are already on the platform are using it more and more. 20% more transactions per user. That's what you call stickiness. People try it, they like it, and they come back. This quote from an analyst really just nails the entire bull argument. The idea here is that Affirm has finally graduated. It's not just a story stock anymore, a company with a good idea but no profits. It's now a proven, profitable machine. But, and you knew there was a but coming, right? If everything looks so great, what are the bears, the skeptics, seeing? This brings us to the other side of the paradox, the reasons some investors are slamming on the brakes. The first major concern is debt. To be able to pay merchants for all those purchases, Affirm has to borrow a ton of money itself. Its debt is more than 2.5 times the value of its equity. For some investors, that's a big risk factor that just can't be ignored. This little scorecard gives you a fantastic snapshot of their financial health. And you can see it right there. Yeah, they can cover their immediate bills no problem, but they get failing grades on their overall debt level, which has actually been going up, not down. And here we go. This was the trigger. This is the smoking gun. Despite that amazing holiday quarter, Affirm's forecast for the next quarter was, well, a lot weaker than anyone was expecting. It basically signaled a big slowdown was coming, and the market absolutely hated it. That's what sent the stock tumbling. So, all of this, the incredible growth, the new profits, the scary debt, the weak forecast, it all leads to the ultimate question of valuation. Is the company's stock actually trading at a price that makes any sense? This chart tells you so much. Affirm's price-to-earnings ratio, which is just a classic way to value a stock, is way up there at 55. That is nearly double its direct competitors and more than triple the industry average. In other words, investors are paying a massive premium for Affirm stock. And that high price means the stock is what Wall Street calls priced for perfection. Think of it this way. When you're valued that richly, investors don't just expect you to do well. They expect flawless execution.
There is absolutely no room for disappointment, so when you give even slightly weak guidance, the reaction can be brutal.
So let's zoom out and put all the pieces together. What are the absolute must-know takeaways from this whole Affirm paradox? This really sums up the whole tug-of-war. On one hand, you have a proven profit machine with a red-hot growth engine in the Affirm Card. But on the other hand, you've got this significant pile of debt and a stock that is priced so high there's no margin for error. That tension is the entire Affirm story right now.
And that really leaves us with the big, lingering question for the future, doesn't it? How's Affirm really turned the corner and built a profit machine that's here to stay? Or is that sky-high valuation a bubble just waiting for the next piece of bad news to pop it?
And as always, just a reminder that this discussion is for informational purposes only. It is not financial advice. Please make sure you do your own research before making any investment decisions.